On Thursday, the inflation numbers came out. Many people started running victory laps as the inflation numbers slowed down more than what was forecasted. And as everybody's concerned about how tight the Federal Reserve is getting, saying they're going to cause a recession or a depression, this is being looked at by the market as good news, as it gives the Federal Reserve room to stop fighting inflation so hard. As a result of the lighter inflation reading, we're seeing the Nasdaq up about 6% and the S&P 500 up about 5%. And the Russell 2000 up about 6% as well. Not to mention assets like gold are up about 2.5%, silver's up about 2.5%. Meanwhile, rates are plummeting, like the 10-year down almost 6% right now. But all that glitters is not gold, and there's actually something nefarious going on here, which is causing these inflation readings to come down. And it's like what I've been saying for a while now, that the Federal Reserve will very soon be able to start running victory laps saying they conquered inflation, but it comes at the cost of individuals, their financial strength, and the economy. When people start losing their jobs, losing hours, getting pay cuts, this is when the Federal Reserve will say, yes, we've done our job. If you take a look at this chart, we can see that inflation has decelerated recently. That doesn't mean prices are coming down. Prices are still moving forward and going up. They're just moving at a slower pace this month than they were last month. Now, if you listen to the Fed and you listen to CNBC and you listen to some of these idiot Nobel Prize winning economists that don't know how the world really works because all they've done is study in a classroom their entire life, they'll tell you that there are all sorts of causes for inflation. But at the root of it is always the expansion of the money supply. And for the last few hundred years, the only way the money supply expands is from artificially easy credit conditions, cheap debt. We do not yet live in a monetary system that is full-blown MMT where they can just create money and destroy money at will whenever they want to fund whatever they want. It still goes through the old archaic system of debt creation. And so we've had sustained inflation for the last year and a half because there has been a massive amount of money that's been working its way throughout the economy. And I've told this story before. Basically, at the beginning, people got some stimulus checks. They got some pay raises. They started quitting their jobs. They started getting better jobs that paid more. And then everybody refinanced. And then everybody went into forbearance on their mortgages so that they didn't have to pay for 6 months, 12 months. And so everybody got cheaper mortgages once they had to start paying them again. And they got a huge chunk of time where they didn't have to pay them at all. And most of those people did a cash out refinance. So they got a big chunk of change in their bank account, $25,000, $100,000, $250,000, whatever it was, pulled the equity out of their house, gave a lot of people a lot of spending power. But guess what? All that is gone now. As pointed out on shiftgold.com, American consumers are digging deeper into debt now in order to deal with rising prices. The latest data shows a consumer debt increase by 6.5%, a total of $4.7 trillion in September. So Americans have tapped out their savings. And so all that new money that worked its way throughout the economy initially was in people's bank accounts and they started spending it. Those savings are depleted now. And the only way that inflation has persisted to this point is because people have to still keep on buying things they have to buy, like food and gas, groceries, just the stuff that's necessary to survive. Their savings are gone, costs have gone up, their incomes have stopped going up, so they've been resorting to plastic instead, which is yet another reason why you don't need interest rates to exceed the rate of inflation for a rise in interest rates to combat inflation. All you need is a debt pile big enough, because if Americans are tapped out on their minimum payments on all of their debt right now, which they are, case in point, auto loan delinquencies are rising and are at their highest point in over 10 years. This means that if interest rates go up just a little bit, people start to default on their debt, or they have to take more income and pay down that debt just to be able to afford their payments. They can't afford to keep on rolling that debt over anymore. And once the debt unwind starts, then you start to see deflation enter the chat very quickly. And we are seeing this happen as the average APR on credit cards has started to increase. Not only that, but it's becoming harder to get new credit cards as well, which is what happens during hard economic times. Lenders start to pull back. Debt gets more expensive. People have to start paying it off. People start defaulting. And so lenders stop lending as much unless they can lend at a much higher rate to compensate themselves for the risk. So while the stock market may be up 6% and gold may be up a few percent, silver may be up a few percent, Bitcoin's rallying from that steep sell-off it had the day before, it doesn't look like news that is good for the consumer. In fact, inflation is starting to slow down now because of the lack of strength of the consumer. They've spent all their savings and now they've spent all of their credit limit as well. The same story as happens every time. This is a boom bust cycle, not an economic cycle, not a business cycle. The boom makes the bust inevitable because it was built on an expansion of the money supply that was enabled by a false easy credit situation. Prices are about to start collapsing. And if you would like to be able to identify what the best companies in the world are and figure out what price you should be buying these companies, get my bear market investing guide linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.